Welcome back. It's time for your call sheet where we look at the topics driving the trading day ahead. The crew members assembled today are Ryan Dietrich of the Carson Group. He's also a CNBC contributor. Mark Smith of Wells Fargo and Jose Torres of Interactive Brokers. Gentlemen, thank you very much for being part of the morning call crew today. Let's start with our first topic, which is going to be the chip trade. A lot of focus today for the right reasons, because it's been a volatile trade, and overnight it's been a hammering for some of these names. Ryan, I'm going to go to you for this one first. The AI trade, yes, it's been powering the markets. Can it still do so? And is this just a sign of things to come?
Well, first off, good morning, and thanks for having me back, Dom. I mean, listen, if you would have said 2 months ago South Korea is down 11%, yet Europe be green across the board and U.S. futures flat, I don't think anyone who believes you. I mean, Dom, this rotation is real. I know lots of people have said it. The reality is if chip stocks keep, quote unquote, crashing, sure, that's going to put a lid on the S&P 500 in the market. But let's not forget, we gained 16% back in April and May, virtually flat the last couple months. So, yeah, of course, we all want the market to always go up. I think this kind of indigestion, this choppiness, it's a healthy sign. And eventually the chip trade and growth are going to come back. But this is why we have a diversified portfolio, because if you do, you're not feeling nearly as bad right now.
Mark, you're the portfolio manager, per se, of this tribunal that we've assembled. From a PM's standpoint, just how comfortable or uncomfortable are you with the chip trade?
Hey, Don, thanks for having me on again. Very comfortable with the chip trade, because when you look at how these companies are performing, they can't keep chips on the shelves, and their earnings are proving it quarter after quarter. So to my guest's last point, if you see any correction in chips, I think you have to go ahead and dollar cost average in, because this is a long story. AI is proven in companies across the board that they're going to be using this, and chips are how you're going to get there. So I'd stay in this trade and continue to dollar cost average in.
Jose, from an economist standpoint, the chip trade is obviously a big part of not just the markets, but the economic drivers, I guess, of what's going to happen in the future. How exactly then do you forecast for just what kind of an impact we could see, given the chip buildouts, the billions, if not trillions, that could be forecast for spending in that chip infrastructure trade in the coming 5, 10, 15 years?
Well, Don, measuring the economic data, we saw yesterday's durable goods orders reflected buoyant appetites for ongoing AI capital expenditures. As far as what it's done for the capital markets, it's been very strong. What we've been seeing lately, however, Dom, is that folks are rotating into names in the Dow Jones Industrial and the Russell 2000. Those two baskets are up in the pre-market despite chips being down significantly. And I also think, Dom, that the Magnificent Seven has some space here to catch up, to show some monetization trends, show some progress on free cash flow, and really revive the chip trade. Throughout this bull market, we've seen periods of doubts about artificial intelligence, valuations, returns, competition from China, et cetera. But all in all, the trend is still intact. The economic backdrop is still robust. And I think the market goes higher just at right here. We're entering a weaker seasonal period. I think buying bonds is a good way to hedge and get some capital gains in the months to come.
All right. A lot of people talking about that bond trade right now these days. Let's talk about our second topic, which is the kind of early part of this busy week of earnings season. A third of the S&P 500 is going to be reporting results, including, Mark, today, the likes of Coca-Cola, United Parcel Service, and Boeing, amongst others, big bellwether type names. What exactly is on your radar with regard to earnings, specifically those non-AI names?
Yeah, Dom, listen, it's a great question. I think that if you look at what's happened it's a very bifurcated market. You're seeing that when I talk to my clients, that there's, if the risk on trade is AI and tech, and everything else is kind of like, we'll wait and see with that, and let's stay in cash. I would say that you've got to really look to diversification, as your guest said earlier. Tech is obviously leading the way this year, and so I continue to stay in that. But the companies that you just mentioned, they really aren't driving investors to want to dive into consumer staples, consumer discretionary. So, I put a pause on that for now and hold any positions you currently have.
All right, Ryan, what do we think in terms of those earnings reports coming up? What's going to stand out to you? Which one are you watching the most?
Yeah, building on what Mark said there. I mean, listen, we all know this has been incredible, right? 86% of companies have beaten 80% on revenue. I think what's fascinating, though, is how the financials started things off with historic numbers, right? We saw that. And how's the consumer? I mean, that's the big thing. How strong is the consumer? We're going to get a lot more data on that coming up. And most of the data that we see still says the consumer, Dom, is in pretty good shape. Not saying things are perfect, but they're pretty solid. So it's been a good start to earnings season, and I bet it continues, the next several weeks here.
All right, and let's move on to our third topic today, which is going to be the FOMC. Big meeting here. It could be live. It might not be. Jose, I'll go to you for this one from an economist take. What exactly are you expecting, baseline, from the Fed and Kevin Warsh, and what exactly could maybe throw markets a little bit more off kilter?
You know, Dom, I think here markets are going to digest this pretty well. When we look at what's happening with inflation, despite this recent spike in oil that we've seen, we're actually seeing here our economist team believes that the July CPI is going to be at around 3.3%. That would be down from 4.2% in May. So despite this brief uptick in energy prices, we still have the CPI disinflation trend intact. On top of that, Dom, the core CPI is at 2.5% in July, based on my forecast. So that really shows that housing disinflation is really bringing down overall costs. I'm expecting that to lead Fed Chair Warsh into more of a dovish tilt in the periods to come. I think we're going to get that pause. However, I do think that September, there's a good chance for a lift. Although if oil can stay below 80, Dom, we're going to see the CPI back in the two handle by December. And I think that's a great story for rates and for the cyclical trade.
All right. And Mark, you mentioned bonds as a diversifier. Specific parts of the bond market that you like, given the FOMC and its rate outlook?
Yeah, you got to stay, short. When I talk to clients, I'm telling you, Iran is on everyone's mind. And if this war continues, you're going to continue to see inflation. The FOMC is going to have to raise rates, unfortunately, no matter what the executive branch thinks. And so I'd stay short.
All right. And then, Ryan, quick word to you. Favorite part of the market?
Yeah, I'll split the middle here. We don't think the Fed's going to do anything. We, in fact, think they're on probably pause the rest of this year. I mean, favorite part of the market, listen, I still think equities. I still think you want to have some growth on one side, want to have some, some value on the other. And we really like financials and industrials.